If you're wondering where you can find a friend in the financial services industry, somebody to help you make the tough decisions, you've come to the right place. Tonight's program is focused on an important question for almost everyone, and that's who do you trust? How do you select an advisor whose business model lines up and doesn't conflict with you? Well, stay tuned for this answer on tonight's Master of Money.
This Master of Money program is brought to you by Harvest Investment Services, a registered investment advisor where they harvest gains and minimize losses, and by Superstock Investor, providing institutional research to individuals. This Master of Money program was produced Tuesday, April 21st, 2015.
Hello again, everyone, and welcome back to the Master of Money program. I'm Steve Beeman, your host, and as always, what a pleasure it is to spend this time with you and share with you the experience I've had over a 30-year career in financial services. The insights and information we give to you through the Society is designed to help you build a better life. Anything we can do to help you do that is our mission. So thanks for joining us once again. Tonight's program, we're going to be covering a very important topic. I've spoken about it with you before, but I get so many questions about this, I want to refocus on it tonight. And that's how to hire the right investment advisor. Who do you trust when it comes to giving you advice? And for that reason, I don't have a special guest tonight, because as I thought about it, the guest I'd like to have is you. How many of you haven't asked yourself that question before? Who can I trust? Where do I turn? Well, we're going to explore that tonight, and we're going to look in more detail than before at types of compensation people get, types of licensing they get, and business philosophies that advisors have, brokers have, insurance agents have that can maybe help you discern where to trust your money, because this is an increasingly important topic, so I hope you find it interesting. Last week, you may recall, we had some time to talk about writing covered calls. We did that at the request of one of the Society members who, I'm pleased to say, said we nailed it right on the money. But during that time, we talked about how covered calls can be helpful to you, helping you increase income on your stocks in the right circumstance. But we also talked about how improperly used, writing covered calls or uncovered calls can actually put you in a very bad position and hurt you in a very real way. Now, we discussed with our good friend Jeff Garbaz some of his thoughts on that, and I heard back from a number of you that we got a little technical, and I'm sure we did. But let me tell you, if you're going to play in that sandbox, you better have the tools to play in it with the big guys. Oftentimes, when I'm talking to people about investing money, I'm reminded of a poker table, and the old adage that says at every poker table there's a fool. And when you sit down, if you can't spot the fool, well, the fool is you. And so here at the Master of Money, we want you to become a master. And that's why from time to time, we may have to get just a little more complicated. Well, as always, if you have questions about that program or you'd like to get more information on it, write us at questions@safefinancial.org. And of course, you can always go to the safefinancial.org website and click through to the Safe Financial Network and view our archives. All of our Master of Money programs are up there, as well as many of our Safe Insights. So we hope you'll take the opportunity to go and view those. Now, looking at our viewer questions this week, I got a question from a person who had attended one of these credit repair seminars. And before they committed to spending the money on it, they wanted to write the Society and ask if it was a true thing. Can these credit repair companies actually repair your credit? Well, first and foremost, kudos to that person for writing us first. It's always the best free investment you can make to get our opinion on these things before you go out and shell out thousands of dollars. Well, here's our response to that. And the answer is, in a nutshell, yes. Very often, these credit repair agencies can help you improve your credit score. And your credit score is very, very critical to you. The amount of money you pay for credit card loans, car loans, home loans, all of that is predicated on your credit score. Now, these credit companies look at the 5 components of credit scores, whether it's the length of time you've had credit, the number of inquiries you've had, your payment history, your debt to equity ratio, in other words, how much of your credit cards are being used. They look at these things and they go in and they try to dispute what is oftentimes incorrect information. When we look at TransUnion or Equifax or the major players here, it is not uncommon for them to have something that's incorrect about you, especially if you've gone through something like a divorce. Oftentimes, you'll be held accountable for your ex-spouse's problems. Well, these credit agencies can go in and get those taken out and frequently then get you an increased score. Again, it's directly important to you because as you go out to borrow money, your cost will be much, much higher if you have a poor credit score. So I suggested to this person he do a little more searching because maybe he wasn't getting the best price on the program. But in a nutshell, it's not a bad idea if you've had kind of a history of some credit problems. So yes, in fact, we've done Masters of Money on credit things before. I've done webinars on them. Maybe we'll conduct a special Master of Money on how to improve your credit score coming up and bring in one of the many experts that we know. Moving into the geopolitical world, boy, oh boy, what another week we've had. This just seems to get more interesting each week. And I know a lot of times we talk about the same things because the same things hit the radar. Last week was an enormous week for Greece. And Greece is fast approaching a real deadline. On the 24th day of April, they have to make decisions on how they're going to pay that debt they owe to the European Union. Right now, it doesn't look like they can. That's caused a lot of concern in the markets, in the global markets especially, but especially there in Europe. We also tie that to Norway. Now, Norway hasn't been on our radar, but in the last weeks, Norway has come out very concerned because Vladimir Putin's Russia has made some overtures toward Norway that put them in the crosshairs of the Russians' aggressive growth territorially. Well, Norway's a little concerned about this, and they're looking at Greece and their exposure to Greece, saying this could, in fact, be a problem not just for the euro, but for NATO in general. And that's a concern for all of us. Yes, the geopolitical things do affect the economy, and therefore they affect your investments. And that's why we bring it up each and every week. Now, as we go down and continue, I wanted to mention, we talk about the Middle East, and there was a potentially explosive situation last week where the Russians agreed to sell some of the most advanced missile technology they have to Iran. Well, you can imagine that didn't sit very well with the Israelis, especially when the Israelis found out the American administration was almost supporting the Russians in doing it, certainly acquiescing to it. This creates increased instability in the Middle East, and that affected oil prices. We've talked in the past how supply is plentiful in oil, demand is fairly stable. The only issue on prices right now is disruption in the supply. We spoke last week about Yemen and how it falls in a very strategic location, and this movement by the Russians to supply missiles to Iran increases the instability for oil, and that's why you saw oil jump up. This is a very concerning move. We'll have to see what happens, but we don't want to see further exploratory things in the Mideast that can maybe unintentionally create real problems. Economically, last week I mentioned to you that we had the IMF and some of the world leaders in Washington discussing the global economy. Now, I will tell you their net result is it's the same thing we've talked about here at the Master of Money. It's a bipolar world right now. Germany has increased its expected growth rates. China has begun a stimulus package by lowering interest rates. And some of the world seems to be okay trying to get well. But throw into that Greece, Venezuela, the problems of China with Japan. You've got instability that has these world economic leaders throwing their hands up saying, we are concerned. Now, let's be straight up. Economics and finance are not necessarily rocket science. You and I know what's going on. It's oftentimes understanding them, though, in a real-time basis that protects us from over and underreacting. Yes, oil ran up to about $65 a barrel. That caused the market to significantly sell off on Friday. But You don't want to react to that because just yesterday on Monday, the markets came back nicely. How often have I talked to masters of money about looking at the numbers and not letting emotions get the best of them? It's highly important. So as you look at these global geopolitical circumstances and you look at the economic effect of them, don't let your emotions get the best of you, and don't let the politicians, the perma bears, and the perma bulls take you by the hand and lead you down a path that will ultimately cost you money. Let's remember in 2009 how many people were told it's over, the market's dead, it will never come back. Well, now we've doubled the market since then, and if you missed out on that, that's a real shame. It's not unusual, though. 1979, Business Week published the headline in their magazine, I forget which week it was, but the headline said, "The Death of Equities, How Inflation Has Destroyed the U.S. Stock Market." The hypothesis at 700 or 800 on the Dow, it would never grow again. Well, okay, where are we now? From 700 to 18,000. Let's not let our emotions get the best of us. Now, I also wanted to mention, I belong to the National Association of Business Economists, and I get all of their research. And I wanted to just relate to you, they have a survey they do from all of the economists around the country on what they think is going to happen in the economy. Well, the survey that just came out from NABE shows most economists believe we're going to have a very nice second quarter turnaround. They attribute the first quarter to the weather, and we did have a pretty tough winter in some parts of the country, and turning down after a very strong third and a very strong beginning of the fourth quarter. So they're looking at the first quarter's performance as an anomaly and expecting growth to come back in the second quarter. Now, of importance to you, we've talked about it before, as growth goes, so will interest rates. But let's not be paranoid about that. We had Doug Roberts on the program just a couple of weeks ago, and Doug was relating how the Fed's position on interest rates right now is, yes, as wage inflation takes place, they want to increase interest rates. But I think the analogy he used was, it'll be like watching moss grow on trees. You're not going to see big spikes in rates, but rather a very slow increase. That could be good for the markets, so we'll keep an eye on that for you. But these economists, they're rarely individually that accurate, but in aggregate, the averages are pretty good. So when they say we'll see a second quarter with an annual growth rate more at 2.5%, I think they're probably right. Well, looking again at the oil situation that we talked about a minute ago, last week the market saw a big sell-off on Friday because of the instability issues with oil. Again, we're looking at the Mideastern turmoil, we're looking at the Ukrainian situation. All of this instability leads to oil price increases, which the market reacted negatively to. Again, on Monday, it came back nicely, and that's something you see in frequent patterns. Big down days followed by big up days. In fact, I'm going to digress for a minute and share something with you that I hear all the time, and it just makes me frost over. It's very common for certain segments of the financial services industry to tell you to what's called a set and forget strategy. Buy that mutual fund and dollar cost average all the time and just be in it no matter what. Their argument to you is, gee, what would happen if you missed the biggest 10 trading days of any given period? Okay, I see their logic, but it misses a key point. The biggest up trading days tend to follow the biggest down trading days. So what they're not telling you, as Paul Harvey used to say, is the rest of the story. So when we see these gyrations in the market, we want to understand that they happen. We don't want to overreact to them, but don't buy into something that, gee, the market jumped up and I should have been in necessarily if before the market was down. If you have any questions, by the way, about that, feel free to write me at questions@safefinancial.org. That's something I just hear people all the time talk about. I dollar cost average down, I dollar cost average up because I always want to be in the market. Well, my experience has been that, yes, the market is a great place to put your money, but do you always want to be there? No, there are times when it screams, go away, run away. And when that happens, you want to make sure that you aren't in it. I want to give you some numbers, by the way, as you go forward looking at your portfolios and where you stand. These are relevant because it shows you the propensity of the market to move. Today, we are trading at a price-earnings ratio of about 20 times earnings, meaning that you're going to expect to earn about 5% on stocks. That's the earnings yield. We'll compare 5% in stocks to 1% in bonds. Not a bad trade. But as we look at other data, there's something called the Shiller PE index. This is a little more sophisticated price-earnings ratio, and it's actually got the market today at 27 times earnings. And yes, as you can probably speculate, that's near the all-time highs. So it gives you more indications that the reason people are in these markets right now is because there's nowhere else to go. The dividend yield on the S&P 500 is about 2%, a little bit less than 2%. So if you add that to this earnings yield concept, the expected earnings from the S&P for you are around 4.5% to 5%. Again, you're not going to go into cash. It's not paying anything. You don't want to go into bonds necessarily because they're not paying that much and they might turn around if rates go up. So stocks, that's where everybody goes. But they are kind of pricey right now, and it just begs the issue that you need to have risk controls put in place. Again, don't feel compelled to be in the market if all of the signals say get out. If you have any more questions on that, of course, please write us at questions@safefinancial.org. Now, when we come back from this quick break, we're going to talk about this issue. I've written about it. It's part of the Path to Prosperity audio library. It's about who do you select as an advisor. And there's a lot to this, but I hear time and time again when I'm out speaking to groups, who do I talk to? Who do I trust? Where do I get the insight and information I can believe in? Well, if you're sitting right now with a 401k or a pension payout, or you're retired, or you're just starting out, wouldn't it be nice for you to know who you can trust? And that's what tonight's program is dedicated to. So sit back and relax during the short break. We'll be right back and we'll continue with this issue of the Master of Money.
Have you ever gone online and Googled the words financial advice? When you do, you get over 3 million results. That's a lot of places that want to tell you what to do with your money. There are new websites that take your information, run it through their calculators, and generate automated financial advice, with recommendations about how you should invest your assets and plan for your future. They're called robo-advisors. But they're not real advisors, because they're not real people. Robo-advisors crunch data, then spit out cookie-cutter recommendations based on financial formulas they have created. Robo-advisors don't know your family, your history, or your personality. They don't know how you feel about your children or your charities. They don't understand what you hope to accomplish with your money. So here's the question. How can you trust financial advice from a source that doesn't actually know who you are or how you feel? You can't. Why? Because you are a person, not a number. You're an individual, not an algorithm. To get personalized advice, you want a qualified financial advisor who knows you, not a computerized avatar that thinks it does. You want an advisor with proper credentials and credibility, supported by an organization with compliant process and protocol. That's what we have. That's who we are. And we have the ability to understand you better than any computer program. Of course, we have the latest innovative technology too, but we use our technology differently. We use technology to support our expertise, not to replace it. We analyze, evaluate, and interpret your data to provide advice specifically for you. Advice about how to achieve your unique financial goals. Robo-advisors can crunch numbers, but numbers are only part of your story. The formula we follow puts you in the center of the equation, and that's exactly where you want to be.
Welcome back. We continue here at the Society to work down our mission to help you build a better and more prosperous life. It's all we're about. And this segment tonight we think is so important because, you know, my friends, I talk to people all the time, and the number one question I think I get is, who do I trust? Where do I go to get unbiased, unadulterated insight and information, because there are so many stories about people who sit across the table and they got hurt by picking the wrong person. So we're going to spend this next segment, just you and me, talking about who you should hire and what you should look for. There are an awful lot of these people. The opportunities for people to manage your money abound, whether it's your banker, your lawyer, your accountant, a CPA, a CFA, CFP. It goes down the list, not to mention your insurance agents. Everybody wants a piece of your pie. So how do you trust them? How do you know who's got their incentives aligned with you? Well, the first thing that we always want to understand is how they're compensated. There are a lot of different compensation schemes in financial services. Some of them align the interest of the advisor with you. Some of them don't. So as we look at compensation, I want to introduce you to a couple of terms. First of all, there are standards of behavior of different types of people in the business. There's something first called the prudent man rule. And what that means is a certain person who's licensed, perhaps by the government, to provide financial services to you must follow a prudent man rule and sell to you only investments that meet your basic needs. In other words, they're going to sit down under that rule and they're going to talk to you about where you stand for risk, for example, or your return needs, and they're going to try to put a product to you that meets those needs, generally speaking. Now, if I'm from Merrill Lynch, I'm going to sell you a Merrill Lynch product because that's suitable for your circumstance. That suitability standard is important. An awful lot of you who hold 401ks have providers of those 401ks who are meeting suitability requirements, but that may not be putting the best product in front of you. So the second standard you should be aware of is a fiduciary standard. Some investment advisors, not all, some of them are fiduciaries. And what that means is a fiduciary by law must put your interest ahead of their own. So if you look at a financial planner or a financial manager who is a fiduciary, almost by definition, they've got your back. Now, they're few and far between. So you want to make sure that the advisor you pick has a fiduciary relationship with you, not just one of suitability. And one of the indicators of that is how they're paid. We all know that it used to be common in the business when I started that brokers could churn accounts. They could buy and sell stocks just to churn commissions. Well, commissions are certainly one way that financial service professionals are paid. They sell you a mutual fund, they get a commission. They sell you a stock, they get a commission. They sell you an insurance policy, they get a commission. Well, that commission's not necessarily bad, but it certainly can raise questions as to whether or not your interests are being put first. I think you can feel that, and you can know it just by the nature of the beast. The second way people are compensated is through participation in an asset-based fee. The average investment advisor draws about a 1% asset fee on their clients, and that's generally all-inclusive, meaning that they could trade all day, every day, buy you in and out of things. They don't get a commission on those trades. They are only paid if your assets grow. So if you start out with $500,000 and they're drawing $5,000 a year from you, well, if they can get you to $600,000, they get a raise too. That's a pretty good way to make sure their interests are aligned with yours. Now, some of these advisors, while they do have a fee basis, will have a la carte products they can sell you. And you have to be careful. It's been my experience that some advisors may advertise the fee basis to draw people in, and the minute they get you, they want to sell you the next fancy annuity or insurance product. Now, it may not be that those are bad. Again, we have to determine whether the advisor is out for a suitability standard or a fiduciary standard. If you have an advisor who has a fiduciary standard with a percent of assets fee type thing, well, that's great. You found somebody who's probably appropriate. If you have an advisor right now and you're talking to them and you question whether they have that kind of motivation, send us a note at questions@safefinancial.org and we'll find out for you whether or not they're abiding in those rules. But there's a lot more than just how somebody's paid. There's also how to look at their qualifications and certifications. If they have what's called a Series 7 license from the organization known as FINRA, this is the government's oversight organization, a Series 7 creates what's called a registered representative status. That person is allowed to sell you stocks and bonds and things like that and be paid in commissions. Other licenses, I hold what's known as a Series 65. That's an investment advisor representative license. I can't sell you a stock, but I can sell you services from an investment advisor. There are a number of other licenses and certifications people get. Frequently, these can tell you what type of advisor they are. Again, if I go into somebody who's insurance licensed, well, they're going to sell me insurance. If I go to somebody who's Series 7 licensed, they're going to sell me stocks or mutual funds. If I go to somebody Series 65 licensed, they're likely going to try to put me with an investment advisor. So that's another key component you need to be aware of as you go forward trying to find somebody to help you with these decisions you have to make. But there are other things to be aware of. When we talk about fee structures, I want to backtrack a little bit because there's one that I didn't bring up I want to. Sometimes people will pay performance fees. Now let me explain to you, this is a very special circumstance. Performance fees are generally not allowed, and that's an illegal thing by the government. So if you go to an advisor and say, hey, how about you take a percent of performance? They can't. And if they do, they're in breach of their legal contract with the government. So the performance fees are only really held by very special partnerships or hedge funds. And when you invest in one of those, yes, the advisor can participate in profits. Typically, those are higher net worth products, and it's something where you might pay 1% of assets plus 20% of performance. Well, that's not bad if, like Steve Cohen at SAC Capital, they're generating 50% a year returns. You're netting 30% a year. That's not all bad. But those are hard to find. They're rare to get into. And if you have one you'd like us to kick the tires again, write me. It's questions@safefinancial.org, and I'll look into that. Now, we want to look at the investment process, and I've written myself notes so I don't forget some of these things. I can't stress enough with you how important it is for you to sit down with this person who wants to manage your money. Again, be it a banker, a broker, an insurance rep, a CPA, an advisor. Determine with them what their investment process is. Do they have risk controls? Oftentimes they don't. If they don't, you've heard me talk in the first segment of this program how important it is to monitor the risk controls on your portfolio. When you have a market trading at 27 times earnings, you want to be prepared if that market turns south. So the risk controls that are either employed or not employed by your potential advisor are huge to be considered. We want to look at their track record, but I would focus with you, if you and I sat down with an advisor and he was trying to sell us on being a client, I'm not as concerned with the numbers of the track record as I am the process of the track record. How long have they employed their investment process? How is it done in good markets, in bad markets, in sideways markets? They employ proper risk controls so you don't get slaughtered when 2008 and 2009 happen. These are questions you need to be asking these folks. You need to ask them whether they are wedded to proprietary products or not. Again, I said earlier that you get a situation frequently, especially in Series 7 licensed individuals, they come out representing a brokerage firm. They're going to sell that brokerage firm's products to you. They're wedded to that set of products. An advisor who has an open structure isn't wedded to any specific type of product. They can sell you anybody's investments as long as they match your needs. Again, looking at you as a fiduciary, not simply whether or not it's a suitable investment. So the proprietary nature of investments is another question that you want to ask. And then also I think it's important to understand whether your advisors operate under ERISA or not. Some advisors don't work with ERISA plans, in other words, 401ks. Some do. I think the ones who do oftentimes will have this higher fiduciary standard they're trying to live by. That really can give you peace of mind. One of my sponsors, Harvest Investment Services, is a fiduciary manager, for example, meaning that by law, Their representatives must put your interest ahead of their own as a firm. Well, your advisor should be in that capacity with you because nobody wants them to put their interest ahead of yours. Again, if you have questions, write us and we'll try to help you determine if your advisor is doing the right thing for you. And if not, we'll try to give you suggestions on where to go. I've spent a lot of time in this business, and so have the other members of the society, and we're going to try to give you that direct advice, so take advantage of it where you can. The final thing you want to consider is often called, well, chemistry. It's simply a function of whether or not you like the person and you would trust them with your kids' money. I talk to people all the time who say they walked out of a meeting and they weren't necessarily comfortable with the guy or the gal, but they certainly thought they knew their stuff. Well, the reality is this is an active relationship if it's done properly, and you need to like the person you're talking to. You need to have that relationship where you feel honest and open and trusted. You know, one of the things that I suggest people talk about is whether their advisor has financial education as part of their offering. You'd be surprised how often financial advisors really don't want their customers and their clients to know what they do. Wall Street has a wonderful habit of trying to make the very simple look complicated. Well, a good advisor is actually going to have financial education for you. They're going to try to lift you up and help you become more aware of what's going on, and through that, they'll become a better advisor. So as you're going out and you look at these things, and so you say, okay, they've got a good fee structure, I'm happy with that. They have a good standard of behavior, whether a fiduciary, the good standard that. I like their investment process with its risk controls and its other critical components. I have a very strong kind of working feeling about this person, a good chemistry, and they're willing to educate me as I grow along with them. Well, that stuff's critical. The other things you want to look for, of course, are whether or not they do financial planning as part of their investment advisory or not. A lot of them don't. Again, I've seen time and time again where people go in and they buy into one form of an advisor or another, and all they get are the products offered by that advisor. What you want is a very good advisor who incorporates their expertise as part of an overall financial plan for you. Again, we've talked about that with Tim Newell from Harvest Investment Services before. The reality is most Americans don't have a viable plan, and you really do need one. We looked at the market Friday that sold off so much. We looked at it coming back Monday. Oftentimes, if you have a plan, you won't get sucked into the emotions of the market. So those are the things you really do need to be looking for. You need to be looking for fee structure, business operating structure, investment process, chemistry, education, a total package to determine whether that person is right for you. And I ask again, and I ask you to take us up on it. If you're talking to someone right now and you're not sure that they fit in that category, send me a note. Write me directly, in fact, at steve@safefinancial.org, and I'll get on it right away to determine whether or not that advisor is within something we would consider to be safe qualified. We're working on a national program as soon as we get the time to start certifying more advisors out there. But if you have one in your area, we'll certainly put that at the top of the priority list. So next week when we come back, we're going to continue on a march on our path to prosperity. In the interim, I hope you'll visit our sponsors. Click on harvestinvestmentservices.net or .com. Take a look at what they do. They do some very good work for their clients. And click on Superstock Investor. They do an awful lot of work providing research to individual investors who manage their own money. So anyway, through the week ahead, I hope that you have a happy and prosperous week, and I look forward to seeing you next week for another edition of the Master of Money.